What's going on, everyone? Today we're going to talk about rate versus price, because what I'm seeing happen right now is a lot of people are holding out for lower home prices, and it's actually resulting in a higher monthly payment, because what it took for those home prices to go down was for rates to go up. Now, I remember beginning of this year, a bunch of my friends sent me videos on YouTube where people were saying, or not people, the experts were saying, if rates go up by 1%, home values would go down $100,000. Didn't make any sense to me. One, it's not the right ratio. If a house is worth $200,000 today and rates go up 1%, how does that house go down 50% in value? It doesn't make sense. It would make more sense if they said if rates go up 1%, values go down 10%. At least there'd be a ratio that makes sense, even though I don't necessarily agree with that logic. So because there were so many people saying that, everyone's been holding off on buying homes, waiting for these home prices to drop. So what I'm going to show you today is, what if I wait for a crash? Where does the savings come from? To show you this, I'm going to give you an illustration of a buyer's guide. I create these for every single client because I want to make sure everyone understands how the money works. I want you to have full disclosure, full transparency going into a home offer or even just into the home buying market. So let's take a look at these two things side by side and see what happened. Okay, so let's use a home price of $500,000 and just say if we bought it a few months back with a rate of 4%. That would give me a mortgage payment of $2,888.55. Now this does include the mortgage, P&I is principal and interest, an estimate of hazard insurance or homeowner's insurance of $100, and property taxes of $520. I'm using 1.25% of the purchase price. In California, that's what we use as a benchmark. This is going to vary all over the country. But the ratio again is the same. I'm using 1.25% on the $500,000 home and then the lower priced home. So the ratio is the same. So if you're in Texas and your property taxes are 3%, the ratio will be the same. So just keep that in mind as we're going through this. So if I take the mortgage, the property taxes, the homeowner's insurance on a $500,000 home at 4%, my total monthly payment is $2,888.55. Now remember, we're waiting for home prices to crash, and a crash is defined by a 25% or higher shift in the market. So what I'm illustrating here is a 30% decline in value, which would equate to a crash. Now watch what happens. My home price went from $500,000 down to $350,000. This is what I've been waiting for. But for that to happen, interest rates would have doubled. Now, when I made this was really kind of for a hypothetical purpose. But in the last couple weeks, today is October 31st, it's Halloween, we've seen rates get into the 7s. So we're quickly approaching that 8% mark. So what was supposed to be kind of a fantasy hypothetical is not so hypothetical anymore. So if a home value crashed by 30% because interest rates went up so high, the monthly payment would be $2,904.35. If I go in and look at the details, my mortgage is more expensive by almost $200 per month. Now my property taxes went down because of the lower price. Homeowner's insurance is probably going to be about the same. So by waiting for a 30% correction, or not, I'm sorry, not a correction. 30% is a crash, not a correction. Waiting for a crash, I didn't save any money on my monthly payment. It's exactly the same. It's actually a little bit more expensive than it was had I bought it sooner with the lower interest. Now let's look at down payment. Let's see how much money we saved in down payment by waiting for a crash. So if I look at my cash to close, buying a home for $500,000 would have had cash to close of about $33,000. Waiting for the crash, it goes down to $25,000. So I save about $8,000, right? Not necessarily. If we look at the savings over the first 3 years, waiting for the lower price actually cost us about $23,000 more in interest. And if we open this up and look at the details, my total monthly payment with the lower price was actually about $6,000 more just in the first 3 years than it would have been if I paid a higher price with a lower rate. Now, I haven't paid down close to as much principal. Because of the way the amortization schedule works, the higher your interest rate, the less principal you're paying, because the bank, of course, is getting their money on the front end. So having a lower interest rate enables your mortgage payment to go more to paying down your principal faster. So when we look at that, you would have paid down $26,000, meaning you have $26,000 more in equity because you would have more principal being paid through your monthly payment. That is why the loan balance would be lower here. But here's a win. Look at how much lower the mortgage is. You have a $323,000 balance after 3 years, where if you paid the higher price, your balance was $448,000. Now, look how much more interest you've paid though, $78,000 compared to $55,000. So when you net it all out, you actually paid about $23,000 more, taking all these factors into consideration. You didn't pay more for the house, but you did pay more to the bank in interest. So while you're waiting for home prices to crash, keep this in mind. One thing that has been bothering me lately is We've lost sight of what the difference between a homeowner and a real estate investor is. Everyone's saying this is a terrible time to invest in real estate. Well, if you're investing in real estate, that is like investing in a stock or investing in crypto. You're investing something. It's a different outlook. It's kind of a business outlook, profit and loss. And when you're investing in real estate, there's a lot of different ways to do it. Do you want to flip houses? Do you want to make money on a monthly cash flow basis? Are you looking for appreciation over time? What is the investment goal that you're making? When you're becoming a homeowner because you're currently a renter, I don't want my landlord jacking my rent up anymore. That's a pretty good reason to become a homeowner. I need 3 bedrooms instead of 2. I just want my own space. I want something to call my own. And more importantly, I know that real estate over time will always win. So instead of paying a landlord, I can pay my own mortgage. Yes, I'm paying interest, but every month I am still paying down my mortgage balance. And over time, real estate always does well. So you have to look at how long you're going to be living in the home as well. So all that being said, I don't know that it's the best decision to wait for a crash. Because remember why home prices go down when rates go up. It's because they're less affordable to more people. I don't want you to be one of the people that can no longer afford to buy the house. The interest rate is going to determine your affordability more so than the home price. If you have any questions, comment below. I'd love to have a conversation about this. I want to play devil's advocate, so let me know how I can help. Thank you so much for checking out this video, and I'll talk to you soon. Cheers.